All right, let's dive into one of the most fundamental and maybe one of the most weirdly named concepts in all of finance, the haircut. And no, it has absolutely nothing to do with a trip to the salon. See, in the world of high-stakes trading and collateral, a haircut is something completely different. It's actually a core safety mechanism, kind of like a shield that's designed to protect the entire financial system when things get shaky. So, what is it really?
Here's the basic idea. Let's say you go to a lender and you put up an asset as collateral, maybe $1 million worth of bonds. Well, that lender isn't going to give you credit for the full million. They'll apply a haircut, a discount, and say, okay, for our purposes, those bonds are worth $950,000. That $50,000 gap, that is the haircut. It's their safety cushion, their buffer against risk.
But that immediately brings up a really obvious question, doesn't it? Why do we even need this protective layer to begin with? I mean, if an asset is worth $1 million today, why not just treat it like it's worth $1 million? It almost seems a little unfair to just chop off some of its value right from the start. But trust me, there is a very, very good reason for all this caution.
And here it is. This is the whole ballgame. The value of pretty much any asset isn't set in stone. It goes up, it goes down, it fluctuates. What's worth $1 million on a Tuesday could be worth a whole lot less by Wednesday if the market decides to take a nosedive. The haircut is basically an admission of that reality. It's a way of saying, hey, we know this value is never guaranteed.
So, how is this discount actually figured out? You might think it's just a guess, but nope. The process is incredibly structured, and it's all about the data. So who makes the call on how big of a haircut an asset gets? It's not arbitrary at all. It's actually a standardized process, and it's overseen by regulatory bodies that have crunched just mountains and mountains of historical data to figure this out.
Now check this out, because you can see the logic right here in the numbers. This is a simplified table from the U.S. Office of the Comptroller of the Currency. Look at U.S. Treasuries. A super safe, short-term bond gets a tiny little 0.5% haircut. Barely anything. But stretch that out to 5-10 years, the risk goes up, and so does the haircut, to 3.5%. Now jump all the way down to equities, stocks, and bam, a massive haircut of 25% or even more. And why? Well, because they're way more volatile.
So it really all just boils down to these three key factors. What kind of asset is it? Is it a super stable government bond or a volatile stock? What's its maturity? Is it short-term or is it exposed to market swings for a lot longer? And really the big one, what's its volatility? How much does its price typically swing around? That's the whole logic right there. Okay, so now we get to the real-world impact, because these numbers, they aren't just for textbooks. They have immediate, powerful consequences, especially when the markets get choppy. And this is an absolutely critical dynamic to understand. When a crisis hits and volatility spikes, regulators don't just sit on their hands. They react. They basically say, whoa, that old safety buffer isn't going to cut it anymore. So they increase the haircut percentages. All of a sudden, that $1 million in bonds that had a 5% haircut might now have a 10 or 15% haircut overnight. And this just perfectly illustrates the chain reaction. Some big market event happens, the regulators respond by making the haircuts deeper, and instantly firms that were perfectly fine a minute ago are now suddenly short on their collateral. They have to scramble to post more cash or sell assets to meet their margin requirements, which creates this massive demand for cash right when cash is hardest to find. It's a really powerful and sometimes painful domino effect. And look, this isn't just a hypothetical scenario. This is a living, breathing system. Regulatory bodies are constantly issuing memos. You can see the real memo numbers here that adjust these haircuts based on what's happening in the market. This is not some ancient rulebook carved in stone. It's constantly being recalibrated.
So, this brings us to the final and maybe the most important piece of the entire puzzle, the invisible engine that makes this whole global system of risk management even possible.
I mean, really think about it for a second. You have thousands upon thousands of different assets, stocks, bonds, you name it, owned by countless different firms all over the world, all subject to rules that can literally change in an instant. How is it even possible to manage all of that? How do you recalculate the risk for the entire financial system on the fly? Because through all of this mind-boggling complexity, you have to remember the goal is actually pretty simple. These haircuts are the shock absorbers. They're built to take a hit so that the whole system doesn't break. So behind every single buffer, behind every updated memo, and behind every real-time margin call, what's really there? What's making it all work? You find a database, a massive, incredibly complex, and lightning-fast data architecture. It's designed to track every single security, to model its unique risk profile, and to apply these changing rules in fractions of a second. This whole system of financial safety that we rely on is only possible because of decades of database evolution. We're talking about the development of systems that can process just unbelievable amounts of data in real time. So the real buffer, it isn't just the rule itself. It's the powerful data engine that enforces it, across the entire globe, every single second of every single day.